How to grow your savings account faster. Are you tired of seeing zeros on your savings account? And you know we're not talking about zeros besides another big number. Saving is more important than ever during these trying times. But even better is to grow your savings account and make wealth fast. So that's why today we'll be presenting you our step-by-step guide for growing your savings account faster. Don't forget to subscribe to our channel and turn notifications on for more videos like this one. So without further ado, let's begin. First step, check what's going in and out. Let's start with the basics. Keeping track of your expenses is extremely important for healthy personal finances. When we check what's going in and out, we are able to properly identify where exactly we're spending our money. You can do this by writing down each and every penny you spend each month, be it something as small as a $5 coffee or a shopping spree at the mall. In fact, most people end up spending more on a daily $5 coffee than on other more important purchases in a year. Most of them don't notice that because they don't organize their spending habits, and then end up wondering where all their money went to after that. Budgeting is the act of creating a financial plan to spend your money. This plan is what's known as the budget. Everyone should budget regardless of their financial situation. And if you're in debt and think your money is spiraling out of control, a budget can help put things into place once more. So if you want to grow your savings account, first you have to learn the art of budgeting, learn to track expenses, and be deliberate about your priorities. Only spend wisely on regular financial obligations like rent, utilities, and phone bills. And keep your spending on the fun stuff in line with what you can afford. A budget is necessary precisely due to that. It helps you keep everything in place and gives you a sense of organization. You'll never feel like you got paid and then all of a sudden your money vanishes in plain sight. Maybe you didn't even notice this previously, but you're spending quite a lot eating out every month, and that's eating part of your budget, making you struggle in your savings or your investment fund. So what should you do in this case? Maybe cut corners in the eating out budget and put these expenses in your savings. Following a budget or spending plan will also help work your way out of debt and keep your finances on track. Second step, pay yourself first. When we say pay yourself first, we're not talking to literally use your paycheck and go splurge on everything you want. Paying yourself first means setting a specific savings contribution from each paycheck every time you receive it. And that's got to be automatic before you begin paying your monthly living expenses and purchasing things you don't need. Most financial planners recommend the Pay Yourself plan as it's the best way to ensure that you continue making your savings contribution every month and after every paycheck. It removes the temptations you might have of spending part of your money on stuff other than your savings. And as we'll see later on, it's not like you can't spend anything afterwards. You're just making sure your savings go to the right place. Third step, the 50-20-30 rule. One of the best ways to budget is by applying the 50-20-30 rule, a simple plan to help you reach your financial goals. Basically, you spend up to 50% of your after-tax paycheck on your needs and obligations. You pay your bills, your debt, and any other necessary payments. So no shopping sprees unless you're literally naked and need new clothes urgently. The remaining half are split between 20% savings and 30% anything else you might want. That way, you have enough money to save, to pay your debt, and to have fun while also paying your bills. Fourth step, invest a percentage of your savings. While saving is important, it's not the safest way to grow your wealth, ironically. If you keep hoarding money and keep it static in a savings account, chances are that it will remain the same way for quite a while. By investing it, you're making your money dynamic. Of course, keep enough money saved up for emergencies, but once you have those covered, invest the rest and have your wealth grow with time. You should understand that there are many money choices you can make when you're young to see an effect on your wealth when you're older. Why should you invest money today, though, if it's going to take so long to reap the benefits? Well, first of all, whether you invest or not, time will pass anyway. If you invest at age 20 and 10 years pass, you'll be 30 and wealthy in 10 years. If you don't invest at 20, the 10 years will still pass, and you won't be as wealthy as if you do the same things as in the first scenario. So always think in the long term. Remember, play the long game. Don't focus only on instant gratification and short-term benefits. This is also another important point, because even if you invest a lot of money at age 20, if by age 30 you don't know how to manage your finances and deal with investments, you're still going to be up to no good. An early start gives your money more time to grow and allows you to take advantage of compounding when you're earning interest on your interest as well as on your savings. That's why it's very important to begin saving and providing for your retirement account as early as possible, as compounding interest is harder to build up when you're older. In fact, if you were to start investing for retirement at age 25, you'll have more money at retirement than compared with someone at age 35, contributing 3 times as much over the years. Dividend-paying stocks are a great way to start investing. A dividend is the payment you receive from a corporation when you buy stocks that pay dividend from it. It's a payment directed to shareholders, where you receive a share of the profits the company made during the year. Creating a stock portfolio is another fantastic way of building big wealth when you're older. To start dividend investing, you must buy stocks that pay dividends to receive regular income from these. Of course, that's in addition to the growth of your portfolio while the stock gains value on its own. On top of that, if the company where you bought your shares has a DRIP, or a dividend reinvestment plan, you can also have your dividends reinvested to obtain additional shares. Fifth step, start a business. If you want to become wealthy by your 30s, you should be looking at one of the best opportunities for building wealth, one that pays off quicker than traditional long-term investments. One of the best ways to do this is to get into the entrepreneurial game and own your own business. Once you own a business, you have unlimited potential to earn, although you also assume more risk. Sure, it might seem completely risky, but most of the richest people in the world have taken that risk and retired before many people have even finished studying. Look at Mark Zuckerberg or Elon Musk, for example. They created their own businesses at early ages, and now they are billionaires, among the richest in the world. On top of that, these risks aren't as dangerous as many people make them out to be, because in business there are calculated risks, which you can carefully analyze before making the decision. Creating your own business allows you to create an even more powerful income stream than by traditional salary, and can even help you feel more passionate about life by doing what you know and love to do best. So, what are your thoughts on these ideas for growing your savings account faster? Let us know in the comments below. Also, make sure to leave us a like, share this video with your friends, and subscribe to our channel for more videos like this one. We hope you enjoyed it, and we'll see you next time for more.